You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Today's guest is Chris Grenzig. He started his real estate investing journey in January of 2016 by trying to flip houses in Long Island, New York. But ultimately, he failed to flip a single house despite spending thousands of dollars in several months trying. Chris and his team tried pivoting to tax deed properties in Philadelphia, but quickly realized it wasn't for them. From there, Chris started to learn about multifamily and started by investing passively in an 8-unit property. Then he joint ventured on another 100 units worth over $4.5 million. From there, Chris quit his full-time job in finance and joined the Toro team full-time in August 2016. Right now, Chris focuses on managing, sourcing, evaluating, and acquiring new assets for Toro multifamily portfolio, and is the primary person running the Florida region of Toro's portfolio. Toro has acquired over 3,500 units worth over $220 million. Chris is also a fellow D1 athlete. He plays soccer. So, hey, Chris, man, how you doing today?
I'm good, bud. Thanks for having me on.
Yeah, no problem, man. Thanks for being the guest today.
Sure.
Obviously I read that pretty fast. Tell us a little bit more about who you are.
Yeah, for sure. So, like you said, my name's Chris. I'm from Long Island, New York. I actually live in Brooklyn now, but grew up in Long Island out east in Smithtown, and, got introduced to real estate, like you said, in January of 2016. So I graduated college in 2014.
Yep.
For anybody trying to do the math, I'm 27, about to be 28.
Right.
And I was working full-time at a stock brokerage firm at the time on Long Island. I had done a year after college trying to coach Division II soccer and youth soccer up in Massachusetts, and I wasn't a big fan of it. And then came back, got a job in finance as a stock brokerage, cold calling, making 300, 400, 500 calls a day, trying to open accounts, generate leads, stuff like that before I was licensed for other people at the company.
Right.
And then I actually got licensed in December of 2015. So right before I found out about real estate, and then I was trying to do it for myself.
Yep.
And I became disillusioned with that part of the industry very quickly.
Right.
I can't speak for everybody, but where I was at and a lot of other companies of a similar size for me, it was very much focused on, what can my client make for me, not what can I make for my client.
Right.
It was very, it didn't sit very well with me. So one of the examples I give was, or like the switch that flipped it off for me, where I was like, this is enough, was my aunt, who is super selfless and she's an amazing person, reached out to me one day right after I got licensed, and she was like, Chris, if I transferred my account over to you, would that be helpful? And I was just like, first off, you're amazing, I love you. And second off, I was like, no, because my company wouldn't care if I lost you money despite you being my aunt.
Wow.
And I was like, if that's how I'm going to feel about, my family member, why shouldn't I feel the same way about a random person? So
Right.
I was like, all right, this is out, this isn't it for me. But, I was told, like, when I was like, all right, I'm ready to quit. A lot of people, my mom mostly, was like, find another job first before you quit. So I ended up staying on for another, 4 or 5 months before I joined Toro. But just to back it up a bit, in January, I got introduced to real estate through my mom and my cousin. They bought a flipping course and kind of dragged me along. And that was I was brand spanking new,
Right.
like a clean baby. I knew nothing. The example that I like to give there is, I thought asbestos was a type of mold. I had no idea what it was. And most people get a good chuckle out of it if they're in the industry. So, my next couple months was, nights and weekends, learning the business, learning real estate, trying to catch up to my mom and my cousin, who had a little bit of a better background. But they were also learning about the flipping world as well. And, for the next 6-7 months, we failed to flip a single home. Didn't put one under contract, didn't buy one, didn't mess one up. And it was for two reasons. One is partially the system that we were brought up in, that we, purchased, was based on quick calculations for renovations and holding costs and purchase price based on the square footage.
Right.
And the reason it didn't work for us in that area was New York is significantly more expensive than most areas of the country.
Right.
However, the blame isn't solely with the program. The blame is also on us, and we didn't execute because, one, there are people that are flipping in our area, just not through that program. So it can be done.
Yeah.
What happened is we decided that instead of trying to take the systems we were given and change it to make it work in this area, we said, let's, we haven't executed, so let's go find somebody that is already executing, and let's see if we can add value to them and piggyback off of them and gain real hands-on tangible experience in an area we're looking to do, instead of just being coached, which is fine. We just didn't have the resource to like spring off of and get going. So we ended up lending about $100,000 to somebody for a flip. And the premise was, hey, can we, learn more about, how you found the property, how you're doing it, and all that stuff. And it was a flip in Pennsylvania, and didn't go great, but we were fine because we were the loan. But through that person, we ended up meeting John, who's one of the founders at Toro, where I work now.
Okay.
And, just through networking and stuff. And what we were going to do was, he had bought like 100+ homes and small multifamily down in Philly at auction and with tax deeds. So he kind of like told us how to do that. We gave it a try. So that's the tax deed part of the bio you were talking about. So my mom had no desire to drive down to Philly. So me and my cousin hopped in a car one weekend. And the way that it was supposed to work was, the auction was on Sunday. You would drive as many properties as you could on Saturday, go to the auction on Sunday.
Right.
We drove all day Saturday, and we just looked at each other at the end of the day and we're like, fuck this. We're not even going to the auction. Like it's not worth it. So came back and just sat down and talked. And just while we got together again with John and just kind of explained what we were thinking and, thanking him and just whatever. And at the end of that meeting, he was just like, hey, I know you guys are trying to do your own thing, but I'm actually raising money for this 8 unit in Covington, Kentucky, which is across the river from Cincinnati. And he was like, would you guys have any interest in investing? And we kind of weren't really sure, but when we started to think about it, we just started learning about multifamily, and we were like, okay, this makes sense. We like this. How do we get into it? And then we kind of thought the same way we did about the loan. We'd gotten that money back. We said, hey, let's invest that money with John, but let's pick his brain about the multifamily side, right? Instead of paying for a course, let's invest in a deal that has a good chance of making us money. And let's see if we can learn on this property and also learn from him. So we said, hey, we'll do it. All we want from you in return is, can we get, coffee once a week or every other week, or jump on a phone call, or, talk about the property? And he said, sure. So for the next 2 months or so, we'd get together and talk and stuff like that. And that was like, I want to say like June of 2016. And at that time I was like, all right, I'm out. I'm so sick of my full-time job. I've got to get out. And one time when I was just randomly sitting down with John, just talking, small world, he had worked for the same people I was currently working for about 5 or 6 years ago. Wow. So he got it. He like understood, he got the whole thing. And like, he had left as well. Yeah. I was like, yeah, I think I'm just going to quit, and, I'll figure it out or do whatever. And hopefully we can make this real estate thing work. And he was just like, hey, I don't know if you'd be interested in this, but, we were thinking about bringing someone on to help us out on Toro. Yeah. Would you be interested? I was like, yeah, like that'd be awesome. So, met his partner, met them, we did like a 6-month trial for like, next to no money basically. Yep. And then it went really well. So it developed into a full-time role. That was August of 2016 when I first started. Yep. They kind of coached me up through their platform, brought me on very early, and, got coached up from there. And it's, like you said, I mentioned from the bio, it's evolved into a role where now, I'm the primary person running everything in Florida for us, which is about to be 1,000 units, about $50 million worth.
Wow.
We just sold one property. We're in the process of selling another. We're in the process of buying another. We just closed one. So it's a really active region for us.
Right.
And, I've just, learned a ton. We've bought about 3,500 units, like you said, a little over 200 million,
Yep.
and, just got a, ton of stuff from it, and, just learned a ton.
Right. And one thing I wanted to mention to my listeners is one of your keys to success is you're always looking for a way to network. I mean,
For sure.
you can go out and buy courses, but one of the best ways to really get into this game is to find somebody that's actually out here making noise and find a way to get involved with them. Whether like you said, you did it for free for 6 months,
Yeah.
and that's what it took for you to get your foot in the door. But I imagine, looking back at it now, you definitely say it was worth it, right?
100%. I mean, to be very blunt, my tax returns for the first, call it 2.5 years out of college, I was below the poverty line. That's
Yeah.
what it was. And part of that was, just trying to find my way in what I was doing.
Right.
But it was, just willing to take a chance and see if it'll work. And thankfully it has.
Right.
I can say I'm no longer below the poverty line, but,
Yeah.
it's worked out really well. So, I was willing to take that chance and that gamble and see if I can make it work. With two people I really liked, and I think we're going places.
Yep.
And yeah, it was probably one of the best, if not, the best decisions I've made.
Right, man. Good for you.
Thank you.
So let's talk about Florida, man. So you say
Sure.
you guys are in Jacksonville right now, right?
Yes. So that's currently the only market we're in Florida. We're trying to expand from there, but we've got a kick-ass management team down there. She's, born and raised in Jacksonville.
Yep.
They're a local regional management team that just does an unbelievable job.
Right.
So it's been an area we've been able to scale really well. And, we're looking to expand from there into areas like Daytona, Orlando, Tampa, Pensacola. So
Yeah.
I could see more of that happening inside the next, call it 12 to 36 months.
Got you. So what are you guys doing to find deals in those new markets?
Yeah. So, I mean, most of it is just, broker relationships and other professional relationships. Multifamily in the areas we're in, so 100 plus units, multi-million dollars, 10, 20, $30 million deals. The truth of the nature is most of those deals have sold within the last 5 to 7 years.
Yep.
And most of them are now professionally owned, institutionally owned, stuff like that. There's not a lot of mom and pop direct to ownership opportunities anymore.
Right.
Unless you start going into really smaller areas. So we're only looking for MSAs, which are metropolitan statistical areas, which is basically the city and the surrounding suburbs,
right,
with at least 1 million people or more. The only one that really isn't is Daytona and Pensacola, but be that as it may. So for that reason, we're not really looking to do too much direct to owner in the multifamily space, because if I spent 2 hours a day, every day for the next year, I'm competing against a broker who's working 10 hours a day, every day, just in one market.
Yeah.
To find a deal, to sell a deal. I'm fighting an uphill battle. So for me, for us, we don't see the value as much anymore in multifamily on that size going direct to owner. Now, if I was looking for 10 to 60 unit properties, I'd be going way harder on direct to owner. But for right now, it's mostly through broker relationships as well as other professional relationships. So our manager, our insurance guys, our lenders, because they're involved with other owners as well.
Yeah.
And they know kind of what we're looking for, and they know, what their other clients are doing or thinking and stuff like that. So we've got a couple of deals through other means, but most of our stuff is through, those broker relationships.
Yeah, I mean, it makes a lot of sense. My day job is a commercial broker here in Greenville with the Overton Group. And, like you said, I'm on the phone all day looking for an opportunity. So it's no way that somebody that's doing it 2 hours a day is going to be able to compete. You're 100% there. So let me ask you, man, you said you guys are looking for, MSAs of a million plus population, but as far as the deal goal, is it like 100 units, 200 units? Like, what are you guys looking for there?
Yeah. So our sweet spot is, call it 100 to 300 units, give or take $15 million in purchase, plus or minus 5 million, in late 60s, 70s, early 80s built stuff. That's like up the fairway for us, pretty easy. as well as it makes sense from a dollar perspective. But, we've bought as low as 60 units and we've bought as much as, 500 units. So we kind of go up and down the scale. We're really looking for deals that we like, deals we want to invest our own money into. We co-invest at least 10% of the equity in every single deal we buy, somewhere as much as, 50, 60, 70%.
Oh, that's great.
So, our primary driver is finding deals that we want to invest in. So, if I find a $5 million deal that we like, I'm going to buy it because, it's fairly easy for us. It doesn't put as much money in our pocket, but it's something I'm willing to invest in, and it's large enough to support syndication. It's large enough to support on-site staff, stuff like that. Like we just bought a deal in Jacksonville that was 92 units. It was a $6 million purchase.
Yeah.
It's a little, it's kind of small for our model, the syndication model, but it's a deal I love. It's a deal I'm going to invest in. It's a deal John, Don, and the rest of our group is going to invest in. And it's in an area we love. It was in Jacksonville. So it made a ton of sense. But if if there was a 50 unit property for $800,000, probably not something we're going to do because it probably doesn't support on-site staff, which we want to have. And the dollars just don't make sense. So, we have a sweet spot. We have a range we kind of feel comfortable in, all the time. But we are willing to stray outside of that for the right deal.
Right. Now, are you guys only looking for value add opportunities or are you looking for more stabilized assets?
So we do anywhere from very opportunistic and distressed properties up to, call it light value add. So we've bought deals that are 100% vacant. We've bought deals that are 50, 60, 70% occupied, and we've bought stuff that's, 99% occupied where you're coming in, renovating units and you're pushing around $100. So we kind of go up and down the spectrum. We have investors that are looking for both. We have investors that are looking for more one side than the other of that, scale. If you take the light value add to the opportunistic, we have some people that want to be here and we have some people that want to be here. We have some people that want to be all up and down the spectrum. So it really depends. But that's, we're just looking for the deals that have value. We're way more interested in the narrative on the deal than the financials, the rent, the cap rate, and things like that. Because I want to know, why is this seller selling? Why should I buy this property? Why am I the right buyer for this property? What's my competitive advantage over everybody else? How am I not just overpaying for this property? So, I want to understand all those things more so than, I'm looking for, a 5.5 cap, 150 units, 1970s built in Raleigh, North Carolina. We're not that group because I think too many people get caught up on just the number side of this business. And it's also as equal to, or maybe more so, a people business. You've got to deal with, the tenants are people, the staff running your property are people, your managers are people, your investors are people, we're people, so the numbers reflect those people. So that's why, I said, one of the reasons we're in Jacksonville is our management team is just kick ass. That's one of the reasons we're there. If the market sucked, we wouldn't be there despite management, but there's a reason we were there instead of, continuing to buy in the Carolinas. Besides prices and cap rates and stuff like that, just a much better management team. It's one of the reasons we're, going to be up to 1,000 units in Columbus, Ohio as well. Our manager up there is just fantastic. We've got, 2 managers we really like, that we work with. We've probably used anywhere from 6 to 8, maybe even 10 management companies over the last 5 years or so. And these are the 2 that we've liked working with the most and continue to have a really good partnership with.
Yeah. Now let me ask you a question about your management team or your property managers. So, you said you guys went through 5 in, the last couple of years over in the Ohio market. So what is it that you guys look for to find a good manager? Because I know a lot of people probably struggle with this as well.
Yeah. So I just want to be clear. It's not that we've hired and fired necessarily all those. It's just some of them have been in different areas of the country and we haven't bought anything there. So,
Gotcha.
We've kind of phased out of those areas.
Yeah.
We have fired some, but just not all of them. The biggest piece for me with property managers is the communication and the alignment of interest, because if you can have people aligned and working towards the same goal, you're going to be way more effective than anybody else. They may not be the best manager, they may not be the smartest person, they may not be the hardest worker, but if you're working together for the same goal,
Yeah.
that is the most important thing to me. So the communication from, from us to our investors, from us to our manager, from us to our on-site,
Yeah.
to our maintenance team, all that is, hugely important, because if you got a property you're going to, sell in 2 years and they think they've got a job for the next 10,
Yeah.
they're going to be looking at this property way different than you are. So we want to, that communication with our managers really important.
Yeah.
We also really like that the two managers we're working with now are more local or regional.
Yeah.
They have scale, they have 3,000 units under management, give or take.
Yeah.
So it's not like we are a massive portion, it's not like we're their only client.
Yeah.
But, they're not a 20,000 units managed property where I'm dealing with the assistant head of, management, where
Right.
we're dealing with, the owners of these companies. We have a direct line to them. They're involved in the businesses. They know what's going on. So there are also some challenges with that as well. But we think,
Yeah.
the benefits far outweigh the downsides. The other thing that both of our managers have together that we really like is they both handle the maintenance side of the properties very well. So we buy, properties that are 40, 50, 60 years old. They're going to have problems. Things are going to break. Shit's going to occur that we can't foresee.
Right.
They do a very good job of staying on top of those things and making sure that they don't escalate into bigger problems. And if they are problems, they communicate them very well. So that's very important for us as well.
Yeah, yeah. Now you said something about alignment of interest, and that's, I heard you say about holding it longer term is going to be better for them. But what else are you doing to make sure that your interests are aligned?
It's the biggest thing is just the communication, just, telling them what we're looking to accomplish.
Yeah.
The length of hold is one thing, but if it's, hey, I want to revamp this property by putting in granite and stainless, it's having that conversation early on and not, springing that up on day one of takeover.
Yeah.
It's talking about things as far as, what type of, how quickly do we want to do renovations? What type of look do we want for the property? It's, how do we want to compensate the employees? Do we want to do more incentive based, or do we want to give them a better base salary?
Yeah.
It's telling them, hey, it's really just the communication is the biggest part.
Yeah.
I think people are okay as long as they know what's going on. It's the same thing when you talk with investors. You ever have a property that's not going well? If you just tell them what's going on, yeah, they're not going to be happy.
Yeah.
They're probably going to be okay. They're going to get over it because you have a good communication with them. It's when you have a property that's not going well and you don't communicate it for 3, 6, 12, 18 months,
Right.
and it continues to get worse, that conversation is brutal.
Yeah. Yeah.
So it's the same in reverse with your management. So as long as you have that open dialogue and everybody's on the same page,
Yeah.
it should be fine. Because if in 6 months they get pissed because we're doing renovations too fast and they don't feel they can keep up, well, my question is going to be, how come that wasn't brought up before we bought it? And
Right.
maybe the answer is, hey, we got it wrong. We
Right.
thought we could handle it and we can't. That happened on one of our properties we just sold. We had a budget for payroll and it was 122 units, but it was scattered site. It was 4 smaller properties. So it was a 16 unit, a 20 unit, a 32 unit, and a 54 unit, I think. It's either 52, 54, 56. I always mess it up.
Yeah.
But anyway, whatever adds to 122. We thought we could manage those 4 properties with 1 manager and 2 maintenance staff.
Yeah.
we were all wrong. We needed an additional management person. So we hired a leasing consultant full time while we were going through the renovation and turnover process. So look, that's going to happen. Stuff like that's going to happen. But we were able to be okay with it because she told us as soon as it was a problem. She told us why it was a problem. We were able to digest it and understand it. And because we had done a good job communicating expectations with our investors up front, when we brought it to investors, nobody was happy to pay an extra $30,000 a year in payroll expense. But they understood that this was a project that was going to be very heavy lifting. There's going to be a lot of unknowns, and that something unknown was going to occur at this property just because of the nature of it. And when it happened, it was okay. That was the problem you guys told us was going to happen. We'll deal with it. So that communication, helped us get over that.
Gotcha. All right, man. So let's segue into the next segment of the show. We're going to look at one of your deals you've done recently, or the one that's most memorable to you, and let's try to learn something from it.
Sure. So we can talk about the property I was, just referencing.
Okay.
So that is, like I said, is 122 units across 4 properties. The 2 farthest properties were about 8 miles apart, so not super far. They're all fairly close to each other, and they were all kind of in a line to a certain degree. So it's like, it was almost like a couple miles between each. So it was a property that was actually brought to our attention from another owner. So these 4 properties were owned by a guy from Jacksonville for the last 20 years. He picked them up over multiple years and has owned them forever. And they were super below market, totally unrenovated, needed a ton of work done to them, but the purchase price was crazy cheap. And there was another owner who owned some stuff there who had put it under contract, but at the same time, it also put I think it was like a car wash under contract in Miami. So he called us and was like, guys, I'm going to be very honest. I put more on my plate than I can handle. I need to get out of one of these. I would prefer to just, assign the contract to you and make a little bit of money than, walk on this and not get anything. So he sent us all the information. It made sense, even with the, a little bit of additional cost to him. And it was a deal we were able to take down in about, I want to say it was May of 2018, give or take. And it was a property that was, a 450, 500 average rent in a 700 average rent area. Not renovated. And it was a property that had no online marketing whatsoever, no branding presence. So we took it over. We brought in professional management, on-site management. We cleaned up a ton of deferred maintenance. We were able to get expenses in line. And over 18 months, we turned about 80% of the units. We renovated about 15 to 20 of them to a higher standard. And we were able to increase rents about, $150, $200 in that short a time frame. There was still a ton of room to run. But about 3 or 4 months ago, we got a call from a broker we know very well. He sold us our first deal in the area, and has just been in great communication with us and said, hey, there's a group buying up some smaller properties, 20, 50, 70, 80 units. They're buying the 2 properties literally across the road from you. Would you consider selling? And we kind of told them, hey, flat out, this property, we expect to sell for 55 a door in the next, 12 to 18 months. If they can get to that number, they can have it now, but it's not something we're willing to budge on. And there was some negotiating back and forth, and they wanted it for less, but eventually they were able to get up to, the price we wanted. They were buying the properties across the road from us for a little bit more, for like 57, 58 a door. So it worked out really well. We were able to sell it for our price that we were looking for in year 3 in half that amount of time. And they were also able to get a slight discount from the stuff they were buying across the road by, purchasing it for more than it's worth today, but probably would be worth probably a similar price in, a couple extra years.
Yeah.
So, there was some give and take from both of us,
Yeah.
but we were able to put the deal together. They closed on the 2 across the road. And then they actually closed on, our 4 properties, the 122 units about a week and a half ago.
Yeah.
So it was a deal that turned out really well.
Yeah.
It was a heavy lifting deal. It was never going to produce cash flow,
Right.
unless we refinanced. But since we sold, it was no cash flow, and we were able to put over a 30% annualized return in our investors' pockets, and make some good money ourselves.
Yeah. Yeah. That's pretty good, man. 30%. That's a win for sure.
Yeah, absolutely.
Wow.
And we knew it was going to be a good deal going into it, or we had a very good feeling.
Yeah.
It ended up turning out significantly better than we thought.
Yeah.
It's not like we're out here, not like no deal we buy do we expect to make 30% on per year.
Right.
We've been fortunate enough that most of our deals have done, in the 20s per year, some much higher, some lower. But the aggregate has been, better than we typically put on paper. But a lot of that has been, the market has helped over the last 5 years. So,
I imagine the IRR was pretty high on that too, since you sold so fast, right?
Yeah, I think it was like, high 20s, low 30s. I forget off the top of my head. And, truthfully, what a lot of people don't realize is when you sell deals, you're not going to know the final return for a few weeks or several weeks, because you have hold back for taxes. There's going to be bills that come in after you close that need to be paid. So what we tend to do is when we close, we at least send people's principal back, assuming we've made money, which we have on all our deals. But we'll send people's principal back. If we know we're going to make a good chunk of change, we'll also send, a return back. But then we want to hold back some money for a few weeks or several weeks as those last couple bills come in, as we figure out the tax consequence from the sale. And then what we'll do is we'll pay all that stuff off, and then the remaining we'll send back. So it'll still be a few weeks before we know exactly what the return ends up being. So I don't have a firm answer for you, like, hey, it was a 31 IRR and a 35 annualized.
Right.
But it's around that between, I would say it's probably a 30 to 35 annualized. It's probably a 27 to a 30% IRR, give or take.
Yeah. Now, how do you guys typically structure your deals? Do you do a 70-30 split?
Yeah, so we had been more flexible in the past, and it was just leading to any time we tried to change it. Why aren't you doing this structure? So the last 4 or 5 deals, what we've done is an 8% preferred return per year, a 70-30 split, 70 to investors, 30 to us, up to a 14%, and then a 60-40 split over that.
Gotcha.
Perpetuity.
Yeah. Good deal. Now, we didn't mention what kind of debt did you put on when you purchased it?
Yeah, so that deal, we did a bridge loan because it needed a ton of work. It also wouldn't have supported the agency loan we would have liked to have seen. One, because the tax reassessment hit was very large. So the new year, our taxes went up about 200% because he had owned it for so long.
Okay, crazy.
So our loan would have been something crazy low, like 65%. And when you're buying it, we bought it for like 30 a door, and we ended up putting about 8 a door into it. It just would have crushed the return. So it was the perfect deal for a bridge loan. I think we did about 80% of purchase. I think we did about 80% of renovation. I think we were about 75% loan to cost. And we did it was a bridge loan, but it was with like a hard money lender bridge loan. And we were able to get a fixed interest rate. I think we did about 8%, which now is very high. At the time, it was only a little high. And the reason we did it was the scattered site and the record keeping was not great. So we knew we were going to have to pay a slightly higher interest rate. And because at the time, 18 months ago, everybody thought rates were going to continue to go up. We thought paying a slightly higher rate that was fixed was the right decision. In hindsight is 2020. We would have been better going off with a floating rate. But at the end of the day, I mean, the deal penciled out with the interest rate we were paying. It was a good loan. It was a good lender. It
Yeah.
worked out well. So I'm not going to, sit here and cry
Right.
after we made 30%. So
Yeah. Yeah.
I think everyone's more than happy with the way it turned out.
Oh
So,
yeah. Absolutely.
but that's part of the thing, when you're making decisions at the time, you're not going to know if interest rates are going to go up or down in 2 or 3 years.
Right.
So, you make the best decision that you can at that point in time. And you gotta live and die by your decision. So, you know, even knowing what I know now, I
Yeah.
still think we made the right decision. We made
Yeah.
the right call. So, it went well. Could it have been better in hindsight? Of course.
Right.
But that's not what this game is. You're never going to maximize everything. You're never going to make the perfect decision. So,
Yeah.
we made the best decision we could have at that time, in my opinion, and it worked out well for us.
Yeah. Yeah. So when you guys are looking at your opportunities, are you planning like a 5 to 7 year exit normally on a normal circumstances?
It depends on the deal. So most bridge loans, you typically only get 3 to 5 year loans.
Yeah.
And most of our exits, we're looking to sell, not refinance.
Right.
So anytime we do a bridge loan, I tell people, expect 3 to 5 years of a hold.
Yeah.
But a lot of our deals we've sold even quicker than 3 years, 18, 24, 30 months, just because we're able to get in, do the work, the value has been created, and
Yeah.
people are looking for deals with some value. So
Yeah.
you can actually, the same way I said it was probably worth maybe a little bit more than 55 a door in 6, 12, 18 more months.
Yeah.
But we're willing to sell it quicker to get that better annualized return, that better IRR for
Right.
a slight discount today. So a lot of
Yeah.
our bridge deals have sold quicker. Any of our deals where we're getting bank debt or agency debt, we're getting 7 or 10 year debt, and we're planning to hold for at least 5 years or more.
Yeah.
But just the way the market's been the last 5 years, even though we've had 10-year debt, our deals were able to sell and hit great returns.
Yeah.
So, we've exited earlier than planned. But, everybody's been saying they think a recession's coming since I've been in the business. So
Right.
who the hell knows what's going to happen, if anything's going to happen, or when it's going to happen.
Yeah.
But because it continues to go month after month, year after year, and nothing's really happened, it's only continued to go up or flatten. Maybe
Yeah.
you can make that argument. I don't even know that you can. We're anxious that there could be some sort of flattening recession, coming.
Yeah.
We are conscious of that. So we are still going longer term. I would expect those deals to be held
Yeah.
5 years or more. But if things continue and cap rates stay compressed, we're not underwriting to 5 cap exits where some of these deals are selling.
Yeah.
We're underwriting to 6.5 cap exits. So we can implement our plan in 3 years,
Yeah.
hit our NOI. 5 cap is going to be massively valuable if we're underwriting to a 6.5 cap. So we would probably exit. So, I sit here and tell people, hey, we've got 7 and 10 years debt. You've got to expect that this is going to go long term.
Yeah.
Because that's, what the debt supports and, where things might go.
Right.
But I also say, hey, there's also a strong possibility if we can do what we expect to do and cap rates can stay low and interest rates can stay low and this economy stays where it is, we could exit in 2, 3, 4, 5 years. So, I just try to be, again, back to the communication, just say, hey, I'm not going to sit here and tell you this is exactly what's going to happen, but here's what we expect. And I'm going to communicate things as they go along and tell you, how things have changed, why they've changed, and what we're thinking. So, that's, how we kind of look at things.
Yeah, that's very smart, man, to be conservative like that, because a lot of these investors out here are trying to find deals, so they're getting a little aggressive on their exit caps, and that could cause disaster if the market shifts, which we know is going to shift at some point. We just don't have a crystal ball to say exactly when.
Yeah, absolutely. And in all our deals, we do cap rate sensitivity analysis. So we'll do we'll look at the exit from let's say we're underwriting to a 6 cap. That's what we think, for example. We'll look at it at a 5 cap, and we'll also look at it at a 6.5, 7, 7.5, and say, okay, like if the world ends or if something happens and we're forced to sell and it's a 7 cap market, what does that look like? And we're most of our deals are still showing 12% returns, 10% returns, 14% returns. So those are the deals we're buying and feel comfortable with. Now obviously several things could happen. Cap rates could get hit.
Yeah.
Rents could get hit as well. Your income could drop.
Right.
So, I'm not going to sit here and pretend that, it's not possible to make less than that.
Yeah.
But, we feel pretty comfortable when we see things like that, hey, we can still execute our business plan, but, interest rates go up to 6 and cap rates go up to 6.5, 7.
Yeah.
We're pretty well insulated. We think we're better positioned than a lot of people in this space.
Right. Cool. All right. So, man, let's shift to the last segment of the show. We're going to go into a lightning round.
Okay.
All right. First question. What's the best advice you've ever been given?
So I don't know about the best advice I've ever been given, but one that's resonated with me very recently is we overestimate what we can do in a year and we underestimate what we can do in 5. And it's resonated a lot because I've seen the outcome of putting in actionable steps to achieving long-term goals. And those actionable steps, good chance, are going to take longer than you think in that year. But after a year, those steps are going to be amplified on what you can actually produce over the long term. So that's resonated with me a lot recently.
Oh, that's good. What's the best book you've read this year?
I'm not a big reader, so I've got a very short list to choose from.
Yeah.
The 2 best books I've read, I think the best book for anybody that's trying to get into syndication is the best ever syndication book from Joe Fairless. I don't even know what the actual title is, but if you look up Joe Fairless, you look for the book that says syndication on it.
Right.
That is like, when people ask what it is, I'm like, that is the best quote unquote playbook overview for what we do. I also read a book called Quitting Like a Millionaire, which I thought was very interesting. I thought it had a very good story from somebody who came from rags to riches.
Right.
Had retired at 31. And I think it places a large emphasis on you have to save money to invest money, which sounds simple, but most people don't save money. And it's something I've noticed a lot lately as, I've grown more of a social presence and online presence, networking. And, I've started talking with more people my age and younger. They don't save money, which is crazy.
Yeah.
And it's just something I always did kind of instinctually or naturally. And it's just something I've always understood.
Yeah.
I think as I've understood that and read that book, I thought it broke it down in a really interesting way.
Yeah, that's cool. I'm going to check that one out. That sounds like a really good read.
Yeah, it's an easy read too.
Yeah.
Which is nice.
Even better.
Yeah.
For sure. All right, so what are some rituals you're doing right now?
Rituals I'm doing. I don't have anything specific, but I've started going to the gym in the morning, which has been awesome. It really helps me get a good foot off on the day, which it's tough because I'm not a morning person at all. And I still struggle to get up some mornings. So this morning I skipped, but I also chugged the bottle of NyQuil last night because I'm sick. I don't know if you guys can hear it in my voice. So I'll use that as an excuse.
Right.
But I've also, like back to the quote, I've been taking a lot more of a short-term focus on things I can do today that are going to accomplish long-term things.
Right.
And it has grown my personal ability by leaps and bounds. It's helped me from finding deals to sourcing deals to raising equity, to doing more social media stuff and marketing. And it's changed the amount of work I'm able to accomplish drastically. So I'm always constantly writing down little small things to remind myself to do and to get done. Because I know over the long term, if you climb a mountain, you've still got to take the first step. It's going to take however many steps. So it doesn't matter that you climb the tallest mountain in the world. That first step is still going to be the same. So for me, I don't know if that's necessarily a ritual, but it's something I've been implementing more that's changed a lot for me.
Yeah. I mean, if you're doing it every day, it's a ritual.
There you go.
Yeah, and I was about to ask you what is the one thing you're doing right now to help you improve your business, and obviously that's writing down your goals for the day and staying focused on them, right?
Yeah, I mean, we, from personal standpoint and from Toro standpoint, we've created longer term goals and we're breaking it down every week, month, and quarter on steps to take to reach those goals. And it sounds silly, and it's something I didn't want to do for the longest time because it felt so arbitrary. But I'm a huge believer in it now.
Yeah. I mean, anybody that's successful, man, 9 times out of 10, they're writing their goals down every day.
For sure.
All right, last question for you. If you can give your younger self, and I know you're still young, but if you can give your younger self some advice in getting into this investing game, what would that one tip be?
Into the investing game. That time is going to seem much shorter once you're through it. So when people start investing, most people don't have millions of dollars to invest day one.
Right.
You chunk off little bits here and there. You're going to see the compounding effect of that in 3, 5, 7, 10 years.
Yeah.
But I promise you, if you start today, even if it's putting $20, $50 into the stock market every month, every week, every day, every other month, every quarter, whatever it is, I promise you in 5, 7, 10, 15, 20 years, you're going to look back and be so happy that you started that day, that month, that week, that year earlier, because every little bit is going to add up over time. And the compounding effect of that, not even compounding interest. I'm just saying, adding $50 on top of the initial 50,
right?
Or, the 50,000 on top of that initial 50,000, whatever your ability is. I'm telling you now, it's going to add up, and it's going to feel super slow while you're in it and while you're doing it. Because if you invest $20,000 into a deal that produces 5% cash flow, that's $2,500. That's not changing anybody's life, right? If we're calling a spade, nobody's getting $2,500 a year that invested 20 and is going, oh my God, that's it, I'm retiring, right? Like that's never going to happen. But I promise you, if you're able to do 20,000 that year and 20,000, next year or in a couple years, I don't, sometimes it takes people enough to save up that amount, going back to it. But if you do 20 and then another 20 and then another 20 and then another 20, well, guess what? That 20 is slowly building equity and it's slowly getting cash flow. And then now that 20 is 40 because you invested another 20. But that original 20 isn't 20 anymore. It's probably 25 or maybe even 30. So now you're up to 50, and it's going to slowly build over time. And eventually you're going to be way farther ahead than you thought you could be, going back to the, in 1 year versus 5 years.
Right.
So starting early, even with what feels like a ridiculously small amount, is huge.
Yeah. Man, that's great. Hey, Chris, man, I really appreciate you being on the show today. Tell my listeners, how can they get in touch with you?
Yeah, absolutely. So email's always good. Chris@tororep.com, TOROREP.com. Or I'm also pretty active on socials. So most is, Instagram @Chris.Grenzig. But I'm also on LinkedIn, Facebook. I just got on the Twitter. I actually just did a TikTok account too to see what that's all about. So socials, just search Chris Grenzig. You can probably find me.
Cool. Well, I appreciate you, man. Let's stay in touch.
Absolutely. Thank you.
All right, later.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.